Hello and welcome to Simple Economics. Today's topic is interest. We're going to be discussing simple interest versus compound interest. What are the differences between the two versions of interest? Simple interest works like this. You receive interest only on the principal capital. So each year you receive the same amount of interest. Government bonds and corporate bonds work just like this. You loan them $1,000, for instance, and each year you get the same amount of interest. Compound interest is different. You receive interest on the principal amount and the previously received interest. So each year you get a higher amount. Savings accounts at banks work just like this. I have prepared two examples, one of each form of interest. Simple interest works like this. Look at the table. In year one, you have a capital of, say, $1,000. Let's say it's a government bond. The interest percentage is 2%, so you receive at the end of the year $20. In the second year, just the same. You receive $20, and also in the third year, you receive $20. As I said before, the interest is always the same amount, and most of the time it's paid in a separate account, especially, of course, when it is in the case of bonds. This is what mathematicians would call a linear function. So each year you get the same growth as measured in dollars as well as the percentage. Now, compound interest. The interest stays in the account and you receive interest on the previous received interests. So each year the interest is even more money. It grows. This is what mathematicians would call an exponential growth. Now look at the example. In year one, you get exactly the same amount as the simple interest example. So you get 2% interest, $20. At the end of the year, the 31st of December, you have $1,020. Now, this is where the magic happens in year two, because you get 2% interest as calculated over $1,020. So you get just a tiny bit more. At the end of the year, you will have $1,040.40. This is also the starting capital for the next year, year three. Again, you receive 2% interest, but this time they calculated over $1,040.40. So again, the interest amount will rise slightly. This is an exponential function. So this form of interest, compound interest, grows much faster.